All right. Hi, everybody. So for the first impression, you don't get a second chance, so hopefully I didn't ruin it already. But I think it's a question of timing, so I will try to make it really fast and to the point. So let's see how can I catch up the time. I'm Thomas. I'm working for DWS. And who is actually DWS? So DWS is one of the biggest German asset managers, strongly coming out of the retail channel, where we are the #1 in Germany. And we belong to the Deutsche Bank group, where actually we are offering a broad offering between active, passive, and alternative funds across the board. So together we have approximately above 900 billion assets under management, and 30% out of it makes our passive ETF offering there. So the ETFs are approximately above 250 billion in size, and the Xtrackers brand developed very strongly over the past, I would say, 10-15 years. So we have also developed 80% of our range, which is physically replicating, and 20% which is swap-based replicating, to really offer the best out of the both worlds. So swap and also physical replicating ETFs there. In Europe, we are the #2 European house, our European provider there. Yeah, in the meantime, it's above 300 investable indices on the background. So the universe, or kind of the granularity of the market, is really huge. And we have heard also before already a lot of really nice ideas what is really possible with ETFs, with index investing. And today I would like to put everything a little bit into context on what has been really going on in the market, what has been the flows, what are the challenges clients actually really face in this kind of market situation we have right now, and maybe what are the solutions or activities we see coming from the market. So what are the kind of investment managers really doing in addressing a lot of risks or concentration risks right now facing the portfolios. Let's jump into it. European flow picture. If it's working. Oh, here it comes. Oh, shit. So this is the second impression. I hope it's not ruining the first one. Let's jump back. I was way too fast for the computer, seems so. So still AI is not there in the room, but coming up. Yeah, here it is. So the global flows have been very much dominated by US equity. We have seen a lot of flows coming into global solutions like MSCI World ETFs, but also very much driven by the US. So we can see it here on the right-hand side. So most of the flows have been equity-driven. And fixed income last year has gotten really interesting because the yield is back in the room. So also on the fixed income side, we have seen kind of quite a nice flows in the government bond space, but also in the cash allocations. If we take a look at it, this one is pretty interesting. So that's money market. But relatively, if we take a look at the asset classes, money market has more than doubled in terms of the size of invested assets in the market. And the rest, like fixed income and equities, have increased market share, but maybe not so much as it seems to be in absolute terms. And why is that the case? So money market, yeah, it's quite a surprising topic. And I'll come back to that maybe in a second. So if we break down equity flows, yeah, the most of it has been US-driven and global-driven. When I say global, it's US. So right now, US is 70% of the index. That means every allocation into a global portfolio, it's also automatically driven by the US flows. ESG is I think still very important. So ESG is still driving a lot of noise, a lot of interest. It has gotten really complex in the market to understand ESG. What does it really mean to have an ESG, maybe ETF or active strategy? And this year was particularly interesting because the very concentrated portfolios are driven by the SRI methodology, so really the top 25% after the selection of the ESG criteria, have had some performance issues, and hence also the outflows in this range have been quite dominant there. So the rest of the market was quite stable, but SRI was seeing the most of the outflows in this perspective. Commodities, we have heard few remarks on commodities before or already, but this is particularly interesting because gold has been performing super strong. So we have seen approximately 20% or 18% on performance last year. But in terms of flows, gold was actually showing outflows. So we have seen 12, 13 billion only in Europe getting out of the ETCs as an investment vehicle. So there is a big mismatch between the performance and the flows, which means the performance right now of gold hasn't been driven by investors. So investors have been getting out of the market, actually. But who's driving the price? Yeah, it's going to be somebody else in the market. So approximately, or probably it's going to be the big institutional investors like central banks, just trying to diversify away from currency reserves in US dollar and accumulating quite a substantial gold reserves there. Okay, this is also too fast. And maybe just to come back very shortly to cash, because the money market instruments are really interesting. And what's the reason for that? Right now, the biggest challenge we have is that banks are not paying interest rates. So right now, bank as an investment could be really interesting because they earn a lot of money. And the clients also kind of encounter this topic. And what is the solution? Yeah. Money market instruments or cash ETFs or overnight rate ETFs, where you get kind of the daily allocation into the daily interest rate without having the necessity to be at a bank and being kind of the receiver of the bank interest rate accounts. And there we have seen a lot of, I think 6 billion in inflows over the last 6 to 8 months into our cash allocations or cash ETFs from that perspective. We have a kind of a challenge in the market, and that is US and technology. Because technology is making, or as we have heard from before from iShares, the big chunk of performance in the market. So if we consider MSCI World, this is the x-axis, it's at 0. US has been outperforming, since the beginning of 2000s. So US was the biggest driver of MSCI World performance from that perspective. If we take MSCI World ex-US, so we exclude US, actually this performance or underperforming of the rest of the world is quite significant. And also in terms of historical considerations, coming to the mean, there is a lot of room for coming back of the rest of the world against the US. The challenge here, also last year, was the top 7 companies have been producing most of the performance, and equal weight strategy is one of those that gives, as we have already heard, one of the diversification possibilities, opportunities in the market. And the interesting thing is, we have seen quite substantial flows into equal-weighted S&P 500, but it hasn't paid out in terms of performance yet. So here we can see the market is already positioning or anticipating this de-risking or reducing the very concentration or high concentration levels in the indices and reacting on the repositioning the portfolios. Because there are not a lot of possibilities to achieve that or to do so. And right now, US makes 70% in MSCI World. So beginning in the 1995, it was approximately 30%, now moving up to 70%. And that is something we need to be aware of. Yeah? If I select MSCI World, automatically I buy 70% of US with that. If we would weight it by GDP, it would be more 50-50. That means 20% lower allocation of US in the index if you would like to replicate a GDP-weighted MSCI World. And the fact is, US has been driving the performance for the last 10, 15 years. US is the strong driver in the performance in these global indices there. And there's no sign that it's stopping right now. The big tech companies in S&P or in NASDAQ are still those that have been performing or contributing very strongly. And the ways to mitigate kind of these concentration risks are, all right, the computer is again quite confused. No, I'm way too fast. No. let's give him a minute. Interesting. All right, maybe you can take a look at it, technicians, but I will, oh, here it comes. All right. So what kind of strategy can I use to diversify my portfolio? So the first one consideration would be MSCI World. Let's take a factor like MSCI World Value. You just increase or reduce the concentration. Okay, so you reduce concentration, but you don't increase the breadth of the portfolio. For US IT or technology, you could use some thematic exposures that would increase your breadth. And also reduce the concentration, like for example AI and big data. But the most efficient way to go is actually equal weighted. So here you reduce very much the concentration in the portfolio and also increase the breadth of the exposure on the portfolio level. So equal weight here is really one of the possibilities to diversify away from this perspective. But it's maybe not so good to be completely away from US. Why? Because it's still performing. And to be honest, like having NVIDIA in the index, who says that it's not going to get the biggest company in the world? That would mean still another 50% of performance being driven just by this one company. But we can break down the MSCI World into components. So like having MSCI World, ex-US, you have a more flexible approach to allocate to US. Then you can take the second step on what is the most efficient solution for US, like a swap, because here you can kind of reduce the tax level on the US dividends. Or you can use US in a combination with S&P 500 equal weighted, or what we see a lot from clients is using technology as the satellite. So having like NASDAQ, AI big data, or MSCI World technology for the technology side of the equation, and then just allocate to equal weighted to have the rest of the market in the portfolio, not to lose out on that. And also coming back to the very interesting Invesco presentation, NASDAQ was really one of the best performers in the market with 55% last year. And also US IT, actually the same performance, but the performance was driven only by 13 or 8 names, which is quite interesting for me because the performance generated is really very concentrated there. And indices like the AI and big data was actually a little bit stronger, but still driven by at least 18 names in the portfolio. So here you can see the decision for choosing the right index or kind of being aware of the concentration risks and situations in the index is very important. Thematics are the last point I would like to make today. And we are speaking about ETFs a lot today, passive investment. And everybody would confirm or kind of agree, yeah, ETF, it's passive, it's replicating the index, okay? But the innovation is very close to my heart in terms of what can we do additionally to develop indices that are doing something different, that are really innovative, that are allowing clients to get access to market or to strategies that are not that common and not maybe pure market cap based. And I mean, just AI is a very nice example for that. It's the big trend word right now. So on all of the conferences, I hear AI in a very, very different or very, I would say, everybody is using this word as a code word right now, okay? Well, let's put it that way. And there is this analogy for a hockey player that says a good hockey player plays where the puck is. So it's a good one, okay? But the great is playing where the puck is going to be. And this is kind of the point. How do I achieve that in the world of finance? To find those names that are actually driving the innovation and will be the future profiters or kind of the future winners of this, for example, AI-driven topic. And here it's about data. Data is everything what we have, okay? So normally we work with revenue data or market cap as a weighting scheme, but there is more. So apart from revenues that are more backward-driven, so historically backward-driven, because companies that have revenues have developed something in the past, okay? But the companies that are developing it in the future are those who are spending a lot on R&D, so research and development, who are really active and kind of in the management commentaries speaking about the vision of the companies. And patents comes into play at this point. So patents are a very valuable source of information for us because the companies that have a lot of patents are also those driving the innovation and the performance there. So here, we have developed a range of NASDAQ indices, so together with NASDAQ, actually using the transformer-based AI architecture. Okay, so we are using AI on the background for already the last 3 years that has been developed back then. Transformer-based AI architecture, what's that? Does it ring a bell for somebody in the room? It's the basis for everything what we speak about AI. Okay, so AI is actually a transformer-based model developed, or it was published by Google, and AI is nothing completely new. Okay, so neural networks back in the 80s, that's actually the same calculation, the mathematical method, but we have included the parallel computing. Okay, so you can parallelly compute a lot of, I would say, data points that makes it so efficient that you move from understanding words really to understanding relationships, and that's where we come in. And we use these AI bots on the background that analyze patterns. Okay, so they analyze this huge amount of data on the background and read and understand all the patent documents, and we want to filter out those companies that are really the leaders of, for example, AI, so natural language processing, big data, cloud computing. And this is kind of something we see as a possibility to filter out companies that will be actually also the future profiters or future winners of this also AI big-driven game. And this kind of innovation can be used for a lot of very interesting topics. So on the one side, yeah, it's AI or big data, or it's future mobility. But it can be also like the next generation of internet. So internet is going to be with us for the next 100 years, and there's also a lot of development. Genomic innovation, yeah, one of the worst performance over the last few years. Yeah, but in terms of mean reversion, this is one of the I would say themes that are very underappreciated by the market. So a lot of innovation going on there. But also in the ESG, we have been developing products based on the UN SDG targets, so UN Sustainable Development Goals. How do we make it investable? So you need to work a lot with data that is a little bit more unstructured than what we know purely from the revenue basis. And here you can see ETF is not only a passive solution. ETF can be a wrapper, a easy access to the market, also with indices that are innovative and giving the clients also very unique access into, yeah, a little bit more active approach, yeah, even though it's maybe not an active ETF. Yeah. So we can speak about everything, but only for 15 or 20 minutes. So my time is over. And thank you very much for your time, for being here, and for your interest in ETFs overall. Thank you.